Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week ending February 10th. Had a pretty volatile week in the markets. Most things started correcting this week. So let's dive right into the charts and take a look at what we're seeing here. Starting with the Bitcoin chart, Bitcoin had a really nice move in January, but we were calling for a correction here, and it looks like we're starting to get that. We peaked out just below 25,000, looks like about 24.4, and it looks like we're correcting now and heading lower. Looking for some Fibonacci retracement levels for support on this one. So the 0.382 retracement would be at just below 21K. Our 50% retracements just below 20K, and our 0.618 retracement is just below 19K. So those are the kind of the three Fibonacci levels that I'm looking for some support on. If we see it bounce off of one of these levels and start to head back up to the upside, I'll be looking to re-enter some long positions on probably some crypto miners, potentially Bitcoin as well. So definitely still staying constructively bullish on this one unless we lose that final level. If we start seeing a price breakdown below that 18.9, 18.8 level, then I'll start to get a bit concerned about the bull run potentially being over in crypto, but I still think there's a pretty strong chance we'll find some support here and likely head higher in the future, but we definitely looks like we're in a bit of a corrective phase right now. And then taking a look at the Ethereum chart, looks like we're correcting on Ethereum as well. Looks like we might possibly be actually on a more of a wave 4 and correcting sideways on this one, as opposed to Bitcoin looking like we got a complete 5 waves up and probably a deeper correction there. So it's possible we might find support just at that 0.382 level on Ethereum, which would be at about 1480 it looks like. We're just about there, so we'll see if it finds support there. But we could see a correction all the way down to about 1360, which would represent the 0.618 retracement. And I think everything could still be constructively bullish as long as we hold those levels. So looking for some sort of support in between that 1360 and 1480 on Ethereum. And then taking a look at the total cryptocurrency market cap, we did get back up above $1 trillion, but we have since lost that level, and also looking for some level of support here between that 0.382 to 0.618, which would be right around 900 billion to looks like about 930, 940 billion. And if we can see some support there, then I think that'll give us some pretty bullish projections on the overall cryptocurrency market, and we'll likely continue to see that head higher, especially if Bitcoin finds support and continues to rally. We'll likely see a lot of the altcoins follow that. Jumping over to the S&P 500, we saw some pretty bullish price action in the markets in January as well, but we're starting to see a bit of a correction here. But I think this is kind of to be expected. Looks like a 5 waves up for our first wave of a sub-degree wave 3, which would be a really bullish move if we do find support there. So looking for support somewhere between about 385 and 395 on the SPY, and if as long as we hold those levels, I'll be looking for the market to continue to rally and head higher. It looks to me like we are just starting off a pretty large wave 3, and if I'm right on that, then that would suggest we'd have an upside target all the way back up to about 475 or so on the SPY, which would just about represent a double top in the markets, which I think would surprise a lot of people, but that's really kind of my base case at this point, especially if that 385 to 395 on the SPY holds. I'll be looking for a pretty big move to the upside once we get this corrective phase in, but I do think there's a pretty strong chance we continue correcting going into next week. And some of the support levels I mentioned are that 385 to 395 level on the SPY for what we'll be looking for support before the next move higher. When we take a look at the breadth measure on the S&P 500, we're sitting at about 70% of our stocks above the 200-day moving average, so that's looking pretty bullish. And we're also above about 65% of the stocks above their 50-day moving average. So for me to really get concerned about this rally completely ending from a breadth perspective, if we saw the S&P 500 stocks get below 50% on that 200-day moving average, then I think that would be signaling a breakdown in the markets. But we obviously need to break down quite a bit before we even got to that 50% level. So for now, things are looking pretty strong on the breadth measures on the S&P 500. And then taking a look at the NASDAQ on our triple Qs, also correcting a bit, looking for some Fibonacci support on this as well. Those levels look to be between about 293 on the triple Qs to potentially down to about 282 or so. So as long as we hold some price action somewhere in that range and find support, then I'll be expecting another leg higher on the NASDAQ as well. And then taking a look at our Dow Jones Industrial Average, we are actually looking a lot more bullish and kind of stronger on this one. It looks like we're really consolidating more than having a major correction. We've got this nice bull flag, bull pennant pattern developing, and we're still kind of trading in between these ranges. So we kind of want to see where we go from here. Obviously, if we see a break to the downside from this bottom trend line, that'd be pretty bearish, and we probably expect a correction lower. But if we do see a break to the upside on this bull pennant, then we'd definitely be looking for another leg higher in the Dow Jones Industrial Average as well. And take a look at the transports. The DJT was looking really bullish after we broke this big descending wedge. We broke that out at the end of January and had a real strong move up in the transports. Now we're seeing a bit of a corrective phase. We are at some support at about that 15,000 level. We'll see if that ultimately holds. But we could potentially even see transports go all the way back down to about 14.4 or so. And I think we could still stay somewhat bullish on this move. And so if everything else plays out, I still think there's a decent chance we do head higher on the transports, but it does look like if we lose that 15,000, we probably will correct a little bit further. And then jumping over the Russell 3000, we talked about breaking out of this descending trend line here that had been in place for quite some time. We did that a couple weeks ago, so we've had 2 weeks of candlesticks to the upside ever since we broke that. This week we did move down a bit on the Russell 3000 as most things were correcting, but we are still holding above that 50-week moving average, and we haven't broke down below that trend line again. So if we stay above that trend line and that 50-week moving average, I think we've also got to stay fairly bullish for the markets. And it's not super surprising that we did correct here because we got up to that center channel line, which has been a very strong area of support and resistance in the past. This thing goes all the way back to the Great Financial Crisis, so there's over a decade worth of price memory here, and it's not super surprising to see a bit of a correction there. But I do think that if we do get that next leg higher in the markets, there's a good chance we'll actually break above and get above that center line on the Russell 3000. And take a look at our Russell 1000 for our large caps. We are up against this Fibonacci extension support resistance at 231 or so. We did resist on that last week, and then this week we came back up, retested it, and then it failed once again. So we'll see how it develops over the next week or two. Like I said, it wouldn't surprise me if we had a little bit more of a corrective phase in the market, but I think it'd be really bullish for large caps as long as we hold that descending wedge trend line as well as that 50-week moving average. As long as those hold as support, I think that's just setting us up for a brief correction before we take the next leg higher in the markets. And jumping over the Russell 2000, also correcting there. Looks like we broke down about below that 190-120 level, which has been a key area of support and resistance for quite some time. So we came up and retested that on Friday, but we didn't get above it. So for now, unless we are breaking above 190-120 next week, then I think the most likely outcome is to the downside for the Russell 2000. We got the anchored VWAP at 186.50 or so that has acted as support and resistance in the past. So we'll see how it contends with that, potentially if it heads lower. And then if we do lose that, then we might potentially see a drop down to retest some of these other moving averages like our 50-day or our 200-day, which are sitting around 181, 183 on the Russell 2000. And then jumping over to our small cap, or not our small caps, these are our bonds here, so the TLT and the IEF. So our TLT is our 20-year bond, the IEFs are 7 to 10-year bond, and things were looking pretty bullish. We almost got above the 200-day on the 20-year, and we actually did get above the 200-day on the 7 to 10, but then we ultimately saw a pretty big breakdown from that. A lot of times you get these failed moves, you'll get a quick move in the other direction, and that's what's played out so far. But we're now sitting at the at one of our moving averages here and holding it at support so far. So as long as we hold that, and decent chance we might rally from here and potentially be close to putting in a bottom on the bonds. That hot jobs report that came in, I think ultimately was what really was the catalyst in shooting the bond market lower for the time being. But I still think that there's a chance that the bond market could ultimately have a pretty solid year this year. But it seems like for now, until we find some level of support, that we're definitely in a bit of a corrective phase in the bond market at the moment. And then jumping over to the growth versus value, still seeing growth outperform value, although this last week we did see value outperform growth just a bit, but the overall trend over the last about month or month and a half has been to the upside on growth. And as we talked about before, when we've seen these bounces in growth last year, especially when the markets were selling off, that was a really strong signal to get in the markets and try to go for some long plays before the next bear market kicks in and kind of sucks everything down again. So we're now getting that third move, and it's been a really nice trade so far to the upside ever since we broke that. So as long as we continue to see growth on a longer term trend, or at least a medium term trend, outperform value, then I think we're likely going to continue to see the markets stay strong and potentially rally higher. Jumping over to our relative rotation graph, we had a pretty big red day in our week in the markets, and we really only saw 3 sectors or 4 sectors that were in the green on the week. 3 of them that were pretty strong were all in the energy space. Natural gas finally had a good week, up 7.3%. We've talked about nat gas just getting almost historically beaten down for really the whole month of January, and I think it's starting before that, towards the end of 2022. But we're really starting to see what looks like a bottom being put in the natural gas space, and I think because it has been so incredibly oversold, there's an excellent opportunity in the natural gas space to go long for a couple of trades. We're going to close out this video showing a couple of those, and we'll get to those in a little bit. But we also saw energy perform really well, XLE and XLP up 4 to 5%. In those sectors on the week, Russia announced cutting some oil output, and even though that doesn't technically affect our market, as most of the Western countries have sort of banned purchasing from Russia, there are countries like China and others that I think are still conducting business with Russia when it comes to oil, and so still a cut in Russian oil is still going to have, I think, a net positive on overall global markets in the oil space, and so I think that's where we've started to see some bullish activity in energy, and really energy is just, even when it's corrected, it's been a pretty minor correction, and so we're still continuing to see some really strong relative strength in the energy space, and it looks like we might be potentially poised for a breakout at some point. Really looking for a little bit more price action to the upside on the XLE, looking for that breakout, and if we get it, I'll definitely be putting a lot of new energy trades on, and that could be coming shortly. And then taking a look at the last sector that did well was the agricultural fund, DBA, up about 0.5%. As we scroll down, though, we can see everything else was in red on the week on all the sectors we track, and some of the worst performers. We saw ARC FinTech, online retail, ARC Innovation, cannabis sector, the retail sector, all down anywhere between 6 to 10%. So, and then everything else was pretty much in the red on the week, anywhere from 0 to, or a little above 0 to 5% or so down. So quite a bit of red on the week, and it definitely, I think, is a decent chance we might continue to see a little bit more corrective phase in the market before we ultimately head higher. Part of that, I think, is a strong dollar and the hot jobs report, but we'll get to the dollar chart here shortly. Jumping over to the VEU, the global markets, minus the United States, we did get above that 200-week moving average, but ultimately fell back down that this week, and so we'll see if we come back down and ultimately retest this support level right around 52. We also have our 50-day or 50-week moving average at about 51.5 or so. So somewhere around that range. If we do continue to sell off on the VE, we'll be looking for some support around those areas. And as long as the dollar continues to rise, I think there's also a strong chance that we'll see some weakness in the global markets. And when we take a look at it on a relative basis, emerging markets divided by S&P 500, we can see we had a big rally here. But these last 3 weeks or so, we've seen that start to correct. So the question is, do we just correct for a little bit of time, and then are we going to continue to see this rally head higher, or was this kind of the only move we're going to see in emerging markets for now? In previous times, we've seen a rally off this bottom trend line, get up to this kind of middle trend line here, and then kind of fail. But there has been a couple times where we've got all the way back up to this upper trend line. So we'll see if we can ultimately break through that middle trend line. If we did, then I think we'd likely get all the way back up to that upper trend line in emerging markets, and that'd be a pretty bullish sign, I think, for that space. But for right now, it's looking like we're getting some correction there. Take a look at the oil markets. Oil had a big week for price action. Started out at 73, almost closed the week out at $80 per barrel. So it looks like it's trying to put in a bit of a bottoming process here, between just above that $70 price level. Still think there's a possibility we might get to that 200-week moving average. If we did see it break down lower, that's now up to about almost $66 a barrel. But if we ultimately see that price action break up above our 21-week EMA, then I think that would be a bullish sign, as each time we've gotten up above that 21-week EMA, that's ultimately acted as strong resistance ever since the sell-off started. So if we see that reversal above the 21-week EMA, I'll be a lot more bullish on oil prices going forward. The commodity CRB index also sitting pretty good for the week, up quite a bit as we once again got down below this 267 level just briefly, and then got that whipsaw back up. So that's been a continuing trend where we break down below that key area of support, potentially looking like a possible breakdown, and then each week, the very next week, we get a whipsaw back up to the upside. So commodities are ultimately holding up pretty strong, and holding really strong support right around that 265, 267 level. Take a look at the HYG High Yield Corporate Bond ETF. We had talked about getting up above that 50-week moving average, but we have gotten above it a couple of times on the week, but ultimately failed and closed the week out below that. And then now we ultimately saw that corrective phase. So that's not super surprising after you see a couple of failed moves across a pretty major moving average like that. We also blew down below that 75 level just slightly. So if we want to be a little bit more constructively bullish on HYG in the short term, we want to see price action get up above that 75 level. If we stay below that, then I think there's a decent chance we could come back down and retest this trend line, which, depending on how long it takes us to get there, would potentially be anywhere between about 73 and maybe 71, 72 on the HYG. And then the question will be whether that holds as support, and then if we ultimately bounce off that, head higher, or if it's just a complete breakdown. If we do see the HYG breakdown and get back into this trend line that it had been in during the recession last year, then I think that would be a pretty bad signal for the markets. But if we see it hold that trend line and then ultimately bounce back up, that I think would be a pretty bullish argument case for the markets. And then taking a look at gold and silver, starting out with the gold chart, we definitely got a corrective phase there. We had a gap down not too long ago in the GLD, and it looks like we're potentially heading a bit lower. Also looking for some Fibonacci extension levels to potentially find some areas of support. We've blown through the 0.382 already. It looks like the next level down will be the 0.5, which is also sitting conveniently right around an anchored VWAP position. So that 170-150 level or so looks like it could be a pretty strong area of support. We also have a ton of volume right around this level between about 172 and 175. So we'll see if that ultimately can hold. If that breaks down to the downside, then I'd be looking for support right around the 169 on the GLD. And then definitely have a pretty high conviction that we'll find some support in some of those ranges and then ultimately continue to head higher, as I think precious metals are going to have a great year. Jumping over to silver, similar story. We're actually sitting in a bit of a bull pennant. We actually had an open that kind of tricked people, I think, into thinking we're getting that breakout. Ultimately, that failed pretty quickly. Then we had a big gap down and broke down below that bull pennant, and then continued to head lower. So, also looking for some Fibonacci levels to find some support on this correction as well. That next level down to about 0.5% retracement would be about 1960 on the SLV, or if we get that 0.618 retracement, it could be as low as about 1893 on the SLV. As long as we hold up above that 1893 level, though, I think I'm still staying more medium to long-term bullish in the sector, and think both gold and silver are going to have a pretty good 2023. Jumping over the interest rates, we've had these trend lines drawn here just to kind of show that we've had a fairly steady and orderly decline in the 2-year. However, this last week, I think it was due to that hot jobs report that came in. Looks like we ultimately are trying to break out a trend and potentially to the upside, so we'll be watching that really close next week. Hopefully we get a bit of a whipsaw and just a break back down on those levels. That'd be a really good sign for the bond market if this was a bit of a failed move and then we saw it reverse to the downside. But if we do continue to see the 2-year head to the upside above that 4.5% level, then I think that's pretty bad news for the bond market, at least in the short term. And then on the 10-year, we're watching this one closely as well. We're just up against this upper trend line support. And so the big question is, do we roll over from here next week, or are we going to break trend on this one and then ultimately head higher? If we do break trend and get back up above that levels, then I think there's a pretty decent chance we might get back up and retest that 4% level on the 10-year, and that would definitely be bad news in the short term for the bond market. But I think hopefully that this can act as support or resistance, as it has the last couple of times. And if we see it start to roll over from here, then this could actually be a good buying opportunity. If we see that 10-year hold this area of resistance and start to sell off lower, then I'm probably going to be a buyer of the bond market at that point. Take a look at the 30-year, similar story, more of a descending wedge pattern on this one, but we're getting up against this third potential test on these levels too, right about 3.9%, with our 30-year sitting at about 3.8% currently. So we'll see if that ultimately holds the support going into next week, or as resistance rather. And then taking a look at our put call equity ratio, we did get a brief period where we jumped back up above the 1 level, but fell back down. So still seeing over the last about 3 weeks or so a lot less kind of panic in the markets. As we can see before that, we had quite a few weeks where there was a ton of excessive put buying protection in the markets, still a lot of fear. We also saw the AI index flip this week, I believe it was, where we finally got more bulls than bears for the first time in quite some time, and I think that correlates too with the fact that obviously people are a little bit more bullish. They're going to panic less. They're going to buy less puts, and we've kind of seen that in this chart here over the last 3 weeks as well. So we'll see if that AAI survey can hold up, and if we'll continue to see people stay bullish. I think it'll ultimately come down to how deep or painful this corrective phase that we're in right now will materialize. And then take a look at the DXY, our dollar chart. We saw a big move off of these levels off this lower support line, sitting at just above 150 or 100.5 rather, and we saw a big strong move up, and now it looks like we're doing a bit of a bull flag off of these levels. So if we see that DXY break above about 103.85 or so, then it looks like we're likely going to be heading higher. And if we do get a breakout, the next level to some area of resistance is right around the 105 on the DXY, and if we break through there, then we'll have to contend with the 200-day moving average, which is sitting about 106.45. But as long as the dollar stays within this descending channel, then I still think the longer term trend is to the downside of the dollar. But as we can see, we're at the bottom end of this channel right now, so we could still see a pretty big move on the dollar, potentially get even as high as about 107, 108 on the DXY, and still kind of be in this down trending, longer term trending down channel. So we'll see how that ultimately plays out, but I think at least in the short term it's looking fairly bullish for the dollar. And then taking a look at the VIX. Our VIX did have a trend break as we've been kind of in this pretty steady declining pattern on the VIX, and also saw some VIX numbers at some of the lowest levels in almost a year, getting down into the 17-18 range. And we ultimately started to see that pop back up, got above, broke this trend line, got above the 50-day moving average, and then ultimately saw a pretty big spike on Friday, but then a lot of that gave it back, and now we're sitting just above 20 at about 20.5 on the VIX. So definitely an increase in the VIX volatility, but also nothing at super elevated levels. When we zoom back a little bit more, looking at last year, we can see that we spent a ton of the year with the VIX well above 20, and quite a bit of time above 25, and even as high as 35 or so, and a few times even higher than that. So definitely saw a lot more volatility last year. So this is still looking quite a bit more mild than what we saw for almost all of 2022, but we'll see if ultimately that continues to head higher. If we see a VIX break above 25 or so, I think that would be a little bit more constructively bearish. But if we can stay below that 25 level and potentially even get back down under 20 on the VIX, then I think that would be a pretty good sign for the markets. Let's go ahead and dive into a couple of trades that I talked about before we wrap things up. So this first one I think is an excellent trade opportunity right now, and you can play it a couple of different ways. This is BOIL, which is a 3x natural gas levered ETF, and so you're getting a 3x return for each dollar that you get out of the natural gas fund. Or you could trade, if you want something a little less risky and you're less comfortable with that volatility, you can trade it just off the ticker UNG. But I'm trading BOIL right now. I like trading this especially after an extreme move to the downside like this, really setting us up for some big upside moves, even if it's just kind of mean reverting type moves in natural gas. So we've got our 2 standard deviation on a 10-year log chart sitting at about $10 plus on the BOIL chart, and so even if we just get up to those levels, which seems highly likely, that's a 52% move from here. And I got into this trade last week, so we're already up a little bit on this trade. So I think that's kind of like a pretty conservative estimate, is to get that 50% move to the upside. If we get to that 1 standard deviation to the upside, we're looking at almost a 200% move from here. And if we can just get back up to kind of a mean reversion level over the last 10 years using this log chart, that's about a 400% move. So I think all 3 of these levels are potentially targets to look for, and I'll be happy with any of the 3. Obviously, a 50% move in a short period of time is phenomenal. If we can get up to that 183, that would be excellent. And if we can, actually mean revert, maybe if we get a little bit of a cold shock to finish the winter up, that could really send that gas to the roof again. And really, even if we got up to these levels at about 33 on BOIL, that would just be kind of a 10-year average. So that represents a 400% return. So definitely a big time upside potential on this thing, and we're extremely oversold on it. So it looks like a pretty good risk reward setup on this as well. So we'll go ahead and wrap it up with that this week. Thanks for tuning in. Make sure to download the ToroAlerts app on the App Store. We've got one for stocks and one for crypto, and we will see you next time.